Hello, everybody, and thank you for joining Make UK and BDO's Q1 2020 report on Manufacturing Outlook. So this is our first edition since the UK left the EU in January, and as such, this report we think will be a barometer for how the sector is faring and how we hope it will grow in future. So to that end, I can click through to the overview slide. You can read a quick summary of our findings from this edition. So overall, last year was a difficult time for UK manufacturing. Now the industry has begun to return to a degree of cyclical normality, albeit it should be noted that the results for this survey predate the last week's events around COVID-19 and the global spread of coronavirus. So they may be subject to revision next quarter. Nevertheless, although the results are not entirely positive this time, confidence among manufacturers at the time of being surveyed was clearly very high, and many firms were gearing up to release new investment, though Scottish and Northern Irish firms are somewhat less optimistic. This is partly, we think, explained by the size of manufacturing as a proportion of the economy in both of those nations, which is significantly greater than the UK average share of 10%, as well as their relatively higher reliance on the EU market for goods exports when compared to England and Wales. So to kick off, as you can see there, output fell as stockpiles were wound down. So the last quarter of 2019 saw the output balance increase to 11%, following a sharp decline earlier in the year, as manufacturers built up emergency stockpiles ahead of our EU exit. This time last year was also the beginning of the unprecedented precautionary stockpiling in the run-up to the first Brexit deadline. This quarter, by contrast, manufacturers have been winding down those stockpiles, and as a consequence, output reported a lower balance of 2% for Q1 2020. It must be noted, however, that this quarter's results analysed the final 3 months to January 2020, whereby manufacturers had knowledge of the outcome of the general election and our EU exit on January 31st and the current and ongoing transition period. But as I mentioned just a moment ago, they predate the last week's events around COVID-19. So this result suggests that the confidence boost achieved by the industry immediately after the election result last December did not translate into significantly improved output performance for the sector. However, greater clarity in the political and economic climate has appeared to restore a degree of normality in the sector, and thus UK manufacturers expect a significant improvement in their output balance over the next quarter to about 26%. Domestic orders have now been negative for 3 straight quarters. The last time UK orders seemed this dire was between 2015 and 2016, when we saw 6 consecutive quarters of negative results. So the demise of domestic orders is concerning. But this indicator has nevertheless been on an upward trend, rising from -5% to -3% this quarter. So at least it is headed in the right direction. Of greater concern is the steep contraction of export orders this quarter to 2%. This year will obviously be a crucial time for UK manufacturing as the government starts to negotiate new trade deals with both the EU and the rest of the world. And the weakness in exports is therefore, we think, epitomises the importance of both UK manufacturers and the UK government taking advantage of the transition period to prepare for the impending changes to the UK's international trade relations. However, it's not all negative. As you can see from that headline, manufacturers expect orders to exceed output. So until last quarter, our surveys highlighted positive, albeit declining values across all measures of orders since Q4 2016. A marginal improvement in domestic orders has had the fortunate impact of outweighing the decline in exports, pushing total orders in an upward direction in what is a repeat result from Q1 2019, so this time last year. Total order balance therefore increased marginally to 4% this quarter, an improved result that keeps overall orders in positive territory. And expectations for the next 3 months, albeit I say this with the qualifier again around COVID-19, are for a very positive quarter at 33% for total orders. As has traditionally been the case, these are the top three markets for UK exports. So as mentioned previously, this report is our first edition since the UK left the EU in January, and as such, it's probably going to be a barometer for our future trade relations. And even though we have now left the EU, as you can see from this chart, the EU remains top of the list as the most important foreign market for UK manufacturers, and will likely, according to the firms we surveyed, continue to do so for the foreseeable and after the transition period, regardless of the outcome of trade negotiations. The top three is then completed by North America in second place and followed by Asia. As some of you may recall, for a brief period last year and in recent years, the Middle East has come in on that chart in second and third position at varying times. But now we have settled back into what has historically been the main pattern, which is the EU in number one, followed by North America and then Asia. So it will be interesting to monitor how that evolves over time. Clicking through to a bit more detail on individual subsectors. So the three that I've circled that I think are the most interesting for today's discussion. The first one is the middle one around basic metals. So the basic metals and by extension metal products sector continues to experience difficult times, and their downstream links to both motor vehicles and mechanical equipment sectors, both of which have been experiencing troubling economic conditions themselves, has only compounded the challenges they're all facing. The purchase of British Steel by Jingyi, the Chinese firm, which we reported last quarter, has now been finalised, but the new owners have confirmed plans to cut about 10% of British Steel's workforce. So we expect overall to see a worsening of output this year by a significant minus 5.1% for basic metals, with knock-on consequences for related subsectors. Switching to the circle on the left of the slide there, following a marked contraction in output from minus 5.3% in 2019, the mechanical equipment sector looks like it will remain in negative territory for the foreseeable, but we expect a rate of decline to slow to minus 4.5% in 2020. The mechanical equipment sector is an important sector because it can be often seen as a proxy for business investment. So the notably low levels of business investment in the UK over the last few years has impacted sales in mechanical equipment. However, this quarter survey indicates that future investment intentions across the board in all subsectors have improved, though any spending will likely take time to percolate through to business performance in the mechanical equipment sector. On a related note, electrical equipment, which is another proxy for business investment, saw growth in both output and employment by 3.8% and 3.7% respectively in 2019. A positive sign from the domestic market that plans are afoot for increased reach in network infrastructure across previously disconnected regions in the UK has provided a boost in demand for the subsector's products. However, worries stemming from the threat of the UK's regulatory divergence from the EU standards are weighing on the subsector, and standing contracts and new business may be jeopardized by foreign customers seeking to mitigate threats to their supply chain. That's something I'll get into in a bit more detail in a moment. Finally, on the right, you can see in a circle there, electronics. So electronics has been a positive force for British manufacturing in recent years, bucking the trend seen by much of the rest of the industry, with double-digit growth in output in 2018, followed by a strong 2019 as well. However, the forecast for 2020 is less positive, with a decline in output of 0.7% predicted. High global demand for automation products has driven the sector's recent growth as the global appetite for fourth industrial revolution technologies grows apace. However, rising competition, particularly from China, has created a tighter market for UK firms and their products. Recent disruptions to international supply chains stemming from the coronavirus outbreak has meant that some domestic suppliers have benefited from new orders, but other UK firms are experiencing difficulties in obtaining semiconductors and other passive components from China for the same reason. So a little bit of a mixed bag for firms in that subsector. As you can see from the title on this one, we expect UK export prices, we have seen that UK export prices have improved, but margins have failed to follow suit. So both UK and export prices improved this quarter, indicating that manufacturers have seen profitability improve on one sense, but margins have failed to follow suit. So overall, profitability has in fact worsened. The latest data reports a mixed batch of results as both UK and export prices improved to 16% and 13% respectively. The widened gap between domestic prices and margins indicates improved profitability domestically. However, manufacturers have seen profitability worsen in export markets as margins fell to -6%. Therefore, this change in margins will impact component makers that rely more on export markets for orders than those that are solely focused on the UK. Nevertheless, again, expectations are that this will improve and that cash flow concerns will abate in the coming quarter. And on that same theme, as usual, manufacturers' confidence in their own business is a little bit higher than that for the overall economy. The members surveyed are generally more familiar with their own business than they are with their rivals or others within the supply chain, and that usually results in that kind of difference between the firm level expectations and national economy expectations being the case. All nations and regions across the UK also reported positive confidence this quarter, except for, as mentioned previously, Scotland and Northern Ireland. This, as I mentioned earlier, is likely a reflection of the relative proportion of manufacturing in Scotland's economy, which is 13%, and Northern Ireland's, where it's 22%, both of which are well above the national UK average of 10%. Northern Ireland's economy in particular also has a high reliance on goods exports to the EU, with 60% of all outbound trade in goods received by EU member states. The cost of failing to secure a trade deal with the EU will be felt in Northern Ireland most acutely as a result, and that's reflected, I think, in the confidence scores that we have received this quarter from members there. On the investment front, a lack of investment has been a key shortcoming for unlocking UK manufacturing potential for a long time now. It's been a crucial concern of ours in many of the recent manufacturing outlook reports that we've published. Our latest survey results report investment intentions at 20%, markedly higher than last quarter's 3%. So you can see the effect that improved political certainty has had on members' intentions for the coming year. However, the rise in investment intentions has been coupled with a decrease in employment intentions, indicating that manufacturers are looking to invest in long-term capital stock instead of short-term human resources. Now, just to make clear, this doesn't mean that firms are planning on letting staff go. Rather, it means that the record levels of recruitment that we saw over the last year in particular are likely to decline as firms switch from hiring staff to more long-term investments. As we saw during the various periods of stockpiling activity in the lead up to the different EU exit deadlines that we had last year, many firms recruited short-term staff to help with those stockpiling activities, which led to record levels of employment. But that was a cheaper and safer way of spending money than investing in new factories and new machinery. We now see, through the political certainty that has come about since the election result and since the UK has now left the EU, that firms are looking to switch into more longer-term investments, expanding factories, developing new products, installing new machinery, in a way that they have really been putting off for a long time now, but they're keen to get back to doing business as normal, which is a good thing overall. This quarter employment balance is reported as marginally positive, though it is the first time employment balance has been reported this low in our research since late 2016 for the reasons I've just mentioned. Although an undesirable result on first look, it is unlikely to be a shock to both the wider industry and manufacturers who saw this downward trend developing since last quarter. However, the lack of growth may not be as negative as it seems. With the very tight labour market we have in the UK at the moment, employment growth cannot occur in earnest without a creation of new jobs. What is more unusual is that for the first time since the run-up to the EU referendum, employment balance is reported to be lower than investment intentions. Typically, we see employment leading above investment, as employment itself can be seen as a low commitment human capital investment. So the juxtaposition of low employment balance coinciding with a positive investment balance is quite unusual. The last time this happened was over a decade ago, and the result is likely a sign of businesses taking a different corporate strategy forward now that we have, as I mentioned, improved clarity. So what does that mean for our predictions, well, our forecast for manufacturing for 2020 is at minus 2.1% and at 1.1% for 2021. And the macro overall economic forecast for the UK is at 0.7% for 2020 and 1.8% for 2021. Note the poor values for 2020 is likely the result of a lack of activity investment from last year and the lag effect that is having. So essentially, while we are seeing clear signs from businesses that all things being equal, they are keen to get back to investing, and that will likely percolate through into positive economic scores in the future. The benefits of those will take time to bed in, so it's more likely to be felt next year rather than this year. And that's the reason why, even though we're seeing positive investment intentions from firms this year, the results of our forecast for the coming 12 months are not as optimistic as might be expected